Do not worry, I'm not one of those guys, but we'll come back to that later on in the video. Today, listen carefully because I'm going to teach you something that could potentially make you a lot of money when interest rates start to go down and asset prices are likely to rise. And in all reality, this could be soon. The ECB, so the European Central Bank, is expected to start lowering interest rates on the 6th of June, followed by the Federal Reserve in the United States on the 12th of June, and the Bank of England within the United Kingdom thinking about also doing it on the 20th of June. So listen carefully because today I will teach you some basic economic theory that will help you to understand what's likely to happen when interest rates go down and the impact it will have on asset prices such as stocks, bonds, and also real estate. And I know you're going to say, come on bro, economics is boring as F. However, I promise you, if you understand the basics and you're able to make money from it, it's certainly not boring. And I actually was able to make quite a lot of money back in 2020 and 21 by understanding these things. Hence wanting to share that with you today. We can already start seeing this playing out in the markets with the FTSE 100, the S&P 500 and the Nasdaq all being at all-time highs. As the market's forward looking, they're already anticipating these gains. So let's get ahead of it and let's learn. But first, let's rewind.
A mysterious new virus.
Coronavirus.
So it's almost 4 years to the day that dreaded virus, coronavirus, came and hit us all in the face. Everything was being locked down, capitalism was ending, we were going back to the ice age, and people were running around panicking trying to buy toilet roll, face masks and hand sanitizers. And also, the stock market was taking an absolute dive. Although what happened was absolutely tragic and people lost their lives and their loved ones, including me, I lost my dear friend Phil. For others, it literally set themselves up for life. If you invested carefully and wisely, whilst everyone else was running around trying to find toilet roll, food supplies and face masks, you could have made an insane amount of money the following few years. This brings me back to my topic of my favourite people. Do you remember those plonkers that used to walk around thinking they were cool with their mask on their chin, not even covering their face, coughing and splattering everywhere? Who were those plonkers? Did they not realise that they're part of the problem? Anyway, let's not get into that, but I don't get it. Do you? If you look online, there's many stories of people that made hundreds of thousands, if not millions of pounds in the years that followed. A few of them are flashing up on your screen now. Luckily for me, I was also able to make a good sum of money, which helped me to pay off my MBA. Not millions, unfortunately, because I didn't have a lot of money to invest at the time. However, I was very happy with the results. And this was down to my basic economic theory understanding. Again, not boring, I promise you. I want you to learn this is not going to be boring when you're making money. My understanding in relation to interest rates and also quantitative easing and the impact that this has on asset prices. Cue the money printer, Jerome Powell. Plus the impact of this led me to invest all of the spare cash I had and ultimately make a good sum of money. I also knew over the long term that although there can be big dips in the stock market, and you can see back in like the dot-com bubble, the financial crisis and also COVID that the market dropped significantly, it always rebounds and over the long term it always goes up. So knowing this, also knowing that the good blue chip companies such as Barclays, etc. were going nowhere, I was able to make some good money and almost doubled my money within a few weeks actually, which is fantastic. You know the even crazier thing? Bitcoin had a low of $4,000 in March 2020. However, the November the following year, it actually hit $69,000. How insane. Imagine investing a few £1,000s into Bitcoin back then. You would have made an insane amount of money within the space of, what, 18 months plus. The one thing I would say though, is I wouldn't advocate that because it's extremely high risk. However, those returns would be phenomenal. And although it was a ridiculously scary situation at the time, even oil was negative a barrel and companies were paying people $37 per barrel to take it off their hand. To me, investing at that time was a no-brainer, especially the upcoming catalysts that were expected as a result of coronavirus. And to be honest, I did have an unfair advantage. My professor at Imperial does sit on the Monetary Policy Committee, so he literally sets the interest rates for the Bank of England. Although I had no insider knowledge, I did learn economics from him. So I did have a good understanding as to what I thought may happen, and this is the knowledge I will share with you today. And here I'm going to say I'm not a financial advisor.
Please, don't sue us. Huh?
So everything I'm saying to you right now is my thoughts, and it's purely for entertainment purposes. However, I think if you follow this approach, if you shift your mindset to think in a similar way, it will probably do you well over the next few years. Next time we have a financial crisis or interest rates start to drop as expected, you know exactly what to do and be able to make money. So going back to COVID, let's talk about what happened at the time, why the government were forced to actually lower interest rates and also to use QE as a way of stimulating the economy. So you can understand firstly what happened, which led to the bubble that we've recently seen, that led to interest rates going up, and then equally why we think they're going to start going down. So you remember, as a result of COVID, there was a worldwide, almost mandated lockdown where people literally couldn't go into their places of work, leave their home, go to restaurants, etc. This led the central banks and governments to actually print money to stimulate the economy. Otherwise, we'd be in a significantly dire situation right now. So the governments were forced to lower interest rates to help to encourage people to spend money, but also to print money via QE. So again, Jerome Powell, money printer meme, you know the one, to literally stimulate the economy to try and keep things going. And you'll also remember a lot of people in the US got stimulus checks. In the UK, you got furlough loans, you got furlough support, etc. So the reason they lowered interest rates and also used QE to pump money into the markets was to try and stimulate the economy. When you lower interest rates, people are less likely to save their money and therefore they look for higher yielding returns, so investing in the stock market, assets, etc. But also, by having lower interest rates, people are more likely to borrow to invest in things such as cars, new watches, houses, etc. And that's obviously what led to the boom that we saw in the 6 to 12 months following that. What I will say here as well is that interest rates tend to have a lag of 6 to 12 months. So when interest rates start to drop or start to go up, you don't really see the full impact of that in the markets in terms of asset prices, etc. until 6 months later. With that said, stock markets are always forward looking, so they do anticipate this. And as you can see, even though company financials aren't looking that great right now, we have all-time highs in the stock market. This is because the markets are anticipating interest rates to go down and potentially QE to follow. You'll also remember how insane this was. You remember the whole GameStop saga where a few traders almost to bring down the financial markets, followed by crypto being extremely frothy. Again, going from $4,000 up to $69,000 within the space of like a year and a bit. Also, Rolex prices, like you couldn't get a Rolex and the only thing you could do was buy one on the grey market, the second-hand market, and they were almost 3x the cost. Equally, you couldn't buy new cars, prices had gone insane, houses were ridiculously hard to buy, etc. This was all a result of the Bank of England, the central banks, the Federal Reserve, etc., lowering interest rates and trying to stimulate the economy. They may have obviously over-egged that, and hence why we've had insane inflation and insane asset prices as a result. And this is where we actually entered an inflationary cycle. So you remember following that, we were having our grocery bills going up 14, 15, 20% even. We had the price of used cars going insane, we houses, etc. This was because of that money printing. You remember almost everywhere in the world it was over 10%, which is a real problem. Governments and central banks actually aim for around 3%, and that's a sign of a healthy economy. So you want the economy to be growing, so inflation to a small percentage is good, but anything over 10% is a significant issue because any cash you have under your mattress, in your bank account, without a good savings account is literally depreciating overnight, and that can be a significant problem for a lot of people. As a result of this, the government and the central banks had no option other than to start increasing interest rates. This was so they could put the brakes essentially on the economy, reduce the amount of borrowing, and essentially lowering the money supply. In other words, they were trying to dampen down the fire, which was insane inflation at the time. It was like a wildfire spreading across Australia or Greece or wherever, and they were trying to drop water on it, but as you can see, it was only dampening the fire, not putting it out. And this is kind of where we are now, where interest rates have been quite high for quite a while. A lot of companies, people, etc., that took on too much debt now are really struggling, especially commercial real estate, house mortgages, etc. They're starting to struggle as renewals are coming up and people are going from like, I don't know, a 0.6% interest rate up to a 5% plus. This is a significant issue, which is obviously causing a lot of companies, people, etc. to default and ultimately lose money. So this leads me to talk about why I think interest rates may start to drop, and also experts in the market are also predicting this. When the governments and central banks increase interest rates, this has a deflationary impact on the economy. The cost of borrowing becomes more expensive, servicing your debt is more expensive, so people have less discretionary money available to go and spend on nice things such as luxury goods. This then obviously impacts businesses, people's livelihoods, etc., which is actually then having a knock-on impact on the economy. People either come up for their mortgage renewals, can't afford it, Companies aren't getting the sales they once were. They've maybe got a lot of stock that they bought at expensive prices. They're having to reduce it significantly. And also potentially they can't get the loans that they previously had. So this leads to a dampened economy where unfortunately people lose money and businesses go bust. And you can look at this as well. So let me show you on the screen here the used Rolex price. I know that's a luxury watch, not many people have it, but this actually shows you the impact of what I mean. So as interest rates went down, used Rolexes went insanely high. This is because a lot of people were sitting on a lot of cash. Now you can see where people are running out of money, this is dropping quite significantly, back to like the pre-pandemic levels. This is exactly what's happening across a lot of assets other than stocks. As I say, stocks are forward looking, so they are starting to anticipate interest rate decreases and then a boom in the stock market. We've also seen significant financial strain in the likes of China. So Evergrande has started to default. That was one of the big conglomerates in China, as well as some of the regional banks. So you remember Silicon Valley Bank, etc., that started to collapse as well in the United States. Lots of companies, as I say, are all levered up to the hilt. With commercial real estate being significantly impacted at the moment, you see lots of articles in the news talking about how commercial real estate could be the next big problem for a lot of people. I actually think this is why there's a lot of return to office mandates, because people have a vested interest in making sure their commercial real estate stays high. But there's a lot of exposure in the banks right now to commercial real estate. If this gets downvalued, it's going to potentially have impacts on asset prices, which could then lead to a financial crisis. Again, encouraging the central banks to actually lower interest rates to try and stimulate and prevent that, as well as potentially some QE if needed. And this is all hinting to the signs of a recession. If you're from the UK, you know EastEnders, you know Ian Beale. Basically, everyone's got nothing left.
I've got nothing left!
To try and prevent this, the central banks and the governments are going to have no option other than to lower interest rates to try and re-stimulate the economy and get it on a balance. As you know, they've probably overshot right now, which is why things are starting to drop. They'll start to lower it, I think, in the next few months. As I say at the start, experts are saying in June, to try and get people to spend money again and re-stimulate the economy before we have a too dire situation. So now let's talk about the impact of interest rates on asset prices. So when interest rates drop, the general economic theory is asset prices are likely to rise. This is because less people are likely to hold their money in a bank when you're not getting a good return on it. So people go after riskier assets such as stocks, real estate, and things such as cryptocurrency, etc., to try and get a higher yield and return. Also, lower interest rates stimulate the economy. As I say, people borrow more and spend more, which then hopefully has a inflationary, but hopefully not too high inflation, otherwise we go back to where we were, impact on the economy and hopefully help making it healthy again. So we're going to talk about three different things here. First, the impact on stocks. Secondly, the impact on bonds. And third, the impact on real estate. So firstly, stocks tend to inflate when interest rates go down. And we have started to see this, as I've touched on. The S&P 500, the FTSE, the Nasdaq are all up right now at all-time highs. Reason being is people pull their money out of the banks and put it into the stock market, hoping to get high returns. In times like this as well, investors often take their money out of things such as fixed income assets, such as bonds, etc., to move to stocks to try and get a higher yield and return than you would in a bond. Secondly, real estate tends to do pretty well when interest rates go down. The reason being is when interest rates go down, it becomes cheaper and easier to borrow money. Therefore, people are able to afford more. Ultimately, this pushes up house prices because you can afford more. There's not enough supply. So this is bidding things up in a supply and demand. So if you look at supply, you look at demand, it bids it up. Secondly, commercial real estate starts to go up because businesses, etc., can start to afford more real estate. So this bids the price up and then people start to invest in things like that as well. This could be a solution to some of the corporate real estate issues we're seeing right now. Hence, maybe pushing the government to lower interest rates even faster. Finally, let's talk about bonds. Bond prices can go up as people are willing to accept a lower yield on their bond when interest rates are lower. Bonds are quite a complicated thing, so I won't get into too much detail right now, but if you're interested, I can make another video on this at another time, or you can just look on Investopedia. But essentially, there's an inverse relationship between the return you get on a bond, i.e. the yield, versus the price of said bond. So one thing I'll also say here is, if this isn't managed very carefully by the central banks and the government, we may hit another inflationary cycle and asset prices may hit a bubble again. this is going to be an issue. So they're going to have to be very careful to manage this correctly. Maybe not lowering interest rates too fast and monitoring what they're doing to make sure that we don't have that issue. As you know, the governments often get this wrong. Cue the Janet Yellen and Jerome Powell transitory speech.
We expect the inflation effects of these increases to be transitory.
What a load of BS that was.
How long does inflation have to run above your target before the Fed decides maybe it's not so transitory?
Anyone that knew what they were doing knew that that was complete rubbish, but they seem to think and con themselves for years that that was going to happen.
I think it's probably a good time to retire that word and try to explain more clearly what we mean.
When interest rates do drop, though, it does tend to lead to a boost to the economy. Reason being, it increases borrowing as it's cheaper to borrow money. It also increases investments. It also increases higher consumption of goods and services, followed by improved debt affordability and excess cash. And finally, the currency weakening, which can also lead to exports. So, for example, if the pound or dollar gets lower because you've lowered interest rates, and there is a relationship that if you lower interest rates, the pound or the dollar, the currency in which that interest rate is there, does tend to get weaker, which leads to exports being potentially cheaper and therefore higher sales to other countries. One thing, and I did touch on this earlier as well, is that interest rates do typically take 6 to 12 months to play out. So you will start to see impact on the market with money supply, etc., 6 to 12 months later. And the other thing here as well is the stock market often overreacts. As you'll see back in 2020, the financial crisis, things dropped significantly, which made asset prices significantly undervalued. So don't get scared by this. And you often see people coming out on Reddit, etc., saying, buy the dip, bruh, buy the dip, bruh. Basically, the reason they're saying that is because they know the markets are irrational and therefore they overreact. However, the markets can stay irrational for a long time. You're seeing The Big Short. Michael Burry thought that the housing market was overpriced. It was a significant issue.
Michael, how are you?
I found something really interesting.
Great, Michael. Whenever you find something interesting,
We all tend to make money.
If you'll excuse me, Dr. Berry, it seems like a foolish investment.
This is Wall Street, Dr. Berry. If you offer us free money, we are going to take it.
Michael, do you hear me? I want my money back.
The poor guy almost lost his fund before actually everyone started to realise.
I smell money. Okay. It's a lot of money. I get it. I can feel you judging me.
Reason being is he had hit it too early. So as people say, the stock market can stay irrational longer than you can stay solvent. So don't put all of your eggs in one basket. Don't take high risk thinking that actually, look, I can make a lot of money here, because it may take a lot longer to play out than you think. So now I want to talk about what I think may actually turbocharge asset prices. So we've touched on interest rates and the impact they have. So again, lower interest rates ultimately mean higher asset prices. However, if you throw quantitative easing, aka money printing, into the mix, this can really turbocharge this. This is like the stock market on steroids. And you'll see, since 2008, the financial crisis, the economy has been drip-fed QE. As you can see on this chart that I'm about to show on the screen here, a significant amount of money to keep things inflated and stop the economy coming to a halt. When you add QE into the mix, this is essentially giving excess money to the market. Everyone's chasing the same assets and the same gains. Therefore, this is pushing things up higher and higher, which can be a significant issue and actually creates income equality, which isn't a very good thing. So the rich get richer, the poor get poorer. We need to try and avoid that. However, the governments are kind of focused on QE right now as one of the remedies to economic decline, etc. So bear in mind, if there's QE, i.e. Jerome Powell comes out of his money printer going, brrr, remember, asset prices are likely to go up even more. So now I want to talk about other things that may happen, less likely, but may happen as a result of interest rates going down. So the first thing, and we've touched on this, is asset price bubbles. So we may get another issue like we had back in 2021, where asset prices go through the roof again that are really unsustainable, don't make any sense from an underlying fundamental basis, but this may happen. Secondly, you may have currency instability. If governments are forced to drop the interest rates too low too quickly, this may spook the markets and it may mean that currency devalues significantly against things such as the dollar, etc. What I will say here though is the US dollar is currently the reserve currency of the world, so that is less susceptible to this than say the British pound, Canadian dollar, or even anything in another country. You may also start to see some issues with the banking system, etc. So If asset prices either increase too high or interest rates go down too low, companies may struggle with their current commercial model when it comes to lending. So there may be some financial instability, which may mean that a few banks, financial organizations, private equity is seen as a risk right now, start to decline, and we may have some issues there. People do say the US banking system, at least the big banks and also the UK banks, are pretty sound right now. There have been measures put in place since 2008. However, who knows, there may be a black swan event. And finally, if lowering interest rates doesn't impact asset prices, which again I think is pretty unlikely, it may be down to a few things. So the first thing is market expectations mismatch. So if the markets have already priced in interest rate drops and they maybe aren't as fast as they're expecting, etc., this may lead to a mismatch and stock prices may not go up as much as you're expecting. This may be down to a misalignment between what the markets expect versus what's happened in reality. So secondly, weak economic conditions. So central banks may be forced to lower interest rates to really boost the economy, but the economy may be so bad that no one is wanting to invest money right now into assets, which means that we won't have that inflationary cycle. And people just hoard cash instead, which can happen on a rare occasion, however is unlikely. But if we don't see asset price increases, it may be down to a weak economy. So up next is asset price correction. So if asset prices are deemed to be too expensive, when interest rates do lower, you may not have that impact that you thought. So asset prices may not go up, they may stagnate, or they may even go down. This would primarily be due to obviously the market thinking that the assets aren't worth what they are currently valued. So there is a thing called the Shiller-P ratio, and this is looking at company valuations in terms of their revenue versus how much the stock price is. As you can see, it's pretty high right now. So there is a risk that stock prices, etc., may not go up in the way that we're expecting. However, that may be unlikely. Up next, we have investor sentiment and risk aversion. So as I've talked about, if we think that, I don't know, asset prices are too high, the economy is too weak, or there's something going on, people may not start to invest that money, and that may cause asset prices not to increase like we're expecting. Also, potentially policy inefficiencies or a lack of trust in the central governments and banks, that may lead to a similar thing, that asset prices won't go up as people may hold money. And finally, financial system vulnerabilities. So if interest rates go down, but the banks, etc., don't want to lend money like we had back in 2008 at the start with the credit crunch, people may not be able to get that cheap money, they may not be able to invest, and therefore interest rates won't have any impact on asset prices in that regard. So finally, now we've talked about what's likely to happen when interest rates go down, especially if you combine that with quantitative easing, I want to talk about ways that you can protect yourself if any of those adverse things happen and asset prices don't go up as expected. So the best things that I would talk about is dollar cost averaging. So this is essentially investing your money into an asset, but doing it at a regular interval. So maybe on the first of the month, you invest $100 or £100, and then the following month you do the same, the following month you do that. So rather than investing $300 at the start, you invest over a prolonged period. This will ensure that you're not buying at the top, you're not buying at the bottom, and also it'll be a smooth trend. So your upside might be lower, however, likewise, your downside will be also mitigated. So it's going to have lower potential risk and reward. However, it's a better way to mitigate from any uncertainty. Up next is using a reputable broker. So back in 2021, we saw a few brokers, I'm not going to name names, but everyone know, primarily the ones that use payment for order flow, stopped people being able to buy assets. And this was the whole issue we had with GameStop, AMC, etc. If they hadn't have done that, it's likely that they may have gone bust. So my advice to you is ensure that you're investing in a reputable broker. You know who those are. You go online, you look at their reviews, etc. But invest in a reputable broker because you don't want them to go bust. Also, look for a broker that has low investment fees. So anything below 1% is typically good. 0.2% is supposed to be the best thing that you can possibly get when you're investing in index funds, ETFs, etc. However, look for low fees. Don't pay a broker too much. Even 1% to a broker equates to around 28% of your gains over the long term if you're investing for the long term. So try and minimize that because that's a lot of money. Also, have a diversified portfolio. So don't put all of your money into crypto, meme stocks, whatever. If you have a diversified portfolio, you're likely to have, as I say, less potential upside, but you're less likely to lose all your money as well. So diversify your portfolio, invest in solid companies such as blue chip stocks, ETFs, etc. So stuff that's going to have less risk exposure and less likely to go bust. Also, only invest what you can afford. And firstly, try and build an emergency fund. So have 3 to 6 months worth of your savings that you need to cover your living expenses, save in the pot, and then invest your money into the stock market. What you really don't want to be doing is investing your money into the stock market, it going down another 20, 30%, and then you being forced to sell because you've essentially just lost 20 or 30% overnight, which is ridiculous. Also, to this point, invest for the long term. Don't think anything you invest is going to be get rich quick. I actually was able to double my money within a few weeks in 2020, but that's not the norm. So invest with the long term in mind. If you put $100 into a stock, think, am I happy to hold that there for the next 10 years? If the answer is no, probably don't invest or invest a lower percentage. And finally, I would always encourage you to look at low investment, low fee ETFs. So maybe the S&P 500, the NASDAQ, the FTSE 100, etc. Don't go chasing cryptocurrency meme stocks if you can't afford to lose that money. Personally, if you can put some good money into an ETF, potentially some blue chip stocks such as like your top companies in the US, UK, etc., and maybe a very small percentage related to cryptocurrency, meme stocks, penny stocks, etc. That's quite a good way to potentially have the upside of those risky assets as well as a balance of obviously the lower risk assets. So hope you found today useful. It would be really good to understand your thoughts and comments in the comment section. Hopefully, when the stock market crashes or when interest rates start to go down, you're prepared next time to actually make money and economics isn't as dull as you thought. And to those chin wearers, you know what I say? Get lost, mate.